Welcome to Tech Money Madness, your daily U.S. stock market podcast. It's April 17th, 2026. And for today's deep dive, well, we've got a seriously wild mission for you.
Yeah, wild is definitely the right word for the data we're looking at today.
Right. I mean, we're decoding the daily market briefing,
Uh,
and we are staring at a stack of data that tells two just entirely contradictory stories.
Completely parallel universes, honestly.
Exactly. Because on one hand, think about your weekend cookout. A pound of ground beef costs like 25% more than it did a year ago. Consumer sentiment is just plunging to absolute record lows.
Brutal out there for the average wallet.
It really is. But then on the other side of the ledger, you've got an AI company, one you might not have even heard of, that just tripled its revenue to an annualized run rate of $30 billion.
30 billion. Yeah, it's gravity defying.
So our goal today is to figure out how these two realities coexist,
Right.
right? And more importantly, what it actually means for you, the listener, trying to make sense of a market that feels this disjointed.
Because it does feel disjointed. Traditional market analysis, usually forces us to pick a lane. We're either in a boom or a bust.
Right. There's no in-between usually.
Exactly. But right now, we're dealing with this severe structural divergence. The macro economy, like where people actually live and eat, is behaving very, very differently from the microeconomies where these massive corporations operate.
Yeah, so let's start there. Let's look at the overarching macro environment first, because it's heavy right now, and the immediate catalyst is obviously the ongoing Iran war.
Right. And geopolitics, well, it rarely stays contained on a map. It immediately transmits into the global economy.
Mhm.
And the main transmission mechanism for that is almost always the energy market.
Because everything requires energy.
Everything. The briefing shows that conflict is driving these severe, sustained energy price spikes. And when crude oil and natural gas surge like that, it basically acts as this universal, unavoidable tax on the entire global supply chain.
I mean, it costs more to run the factory, more to put fuel in the cargo ships, more to keep the lights on at the retail store, all of it.
Yeah, and that cascades directly down to the consumer, which is why we're seeing consumer prices up 3.3% in March.
3.3%. And the briefing notes that this quote-unquote met expectations.
Right. Wall Street's expectations.
Yeah, but meeting Wall Street's expectations doesn't mean it doesn't hurt when you're just trying to pay your bills. Because a 3.3% increase layered on top of all the inflation we've already had over the last few years.
It's compounding.
Exactly. It means the baseline cost of simply existing is getting so much steeper for you and everyone else.
Which brings us to the psychological toll of all this. The data shows consumer sentiment has tumbled to a headline index of 47.6.
Wow, 47.6.
Yeah, that is a record low.
I really want to pause on that number for a second because consumer sentiment, it isn't just a survey of, how optimistic people feel.
Right, and not at all. It's a leading indicator.
Right, it's the velocity of money.
Yeah.
If I feel financially insecure, I delay replacing my refrigerator.
Yep, you hold on to the cash.
And because I don't buy the fridge, the appliance store doesn't order new inventory. And because they don't order inventory, the manufacturer cuts a factory shift.
It actively starves the economic engine.
Yeah.
That is the exact transmission mechanism of a slowdown.
Yeah.
And the anxiety isn't abstract, it's deeply tied to immediate costs.
Like cattle futures.
Oh, yeah, the beef data.
Yeah, I was digging through the micro trends in our sources, and cattle futures contracts have jumped more than 25% over the past 12 months.
Which is huge, especially with grilling season right around the corner.
Right. I mean, you might not track global energy markets on your phone every day, but when you go to the grocery store and the ground beef for burgers is suddenly a quarter more expensive than last summer, that inflation is undeniably tangible.
It's local.
Exactly. It's local. And that is the reality driving that 47.6 sentiment score.
And it creates an incredibly precarious environment for the Federal Reserve.
Oh, absolutely. Let's pull the Fed into this because we have notes from Fed Governor Waller and New York Fed President Williams.
Right. And they're signaling what?
They're signaling that the central bank might just remain on hold with interest rates. Williams specifically pointed out that the war could slow economic growth while simultaneously aggravating inflation.
Which is just a nightmare scenario. That combination is the textbook definition of stagflation risk.
The dreaded stagflation.
Yeah, because typically a central bank relies on a standard playbook, right? If inflation is hot, they raise rates, make borrowing expensive, cool down demand.
Right.
And if growth is stalling, they cut rates, make borrowing cheap, stimulate demand, but when growth is slowing and prices are rising at the same time,
You're trapped.
you're totally trapped. Pulling either lever aggressively can trigger a massive crisis.
It's like think about driving on a highway in the winter, right? And suddenly you hit this massive patch of black ice.
Oh, that's a good analogy.
Right. The Fed is behind the wheel. They see the danger. Labor market risks on one side, inflationary war pressures on the other, but they know that if they take sudden aggressive action like slamming on the interest rate brakes or jerking the steering wheel,
They'll spin out.
exactly, they are going to send the entire economy spinning into a ditch.
So the safest move is to, well, take your foot off the pedals, hold the wheel steady, and just glide over the ice until you feel the tires catch traction again,
Just hold on and pray.
basically.
Eh,
And that is effectively what holding rates steady accomplishes. They're just waiting for the underlying environment to stabilize. Though, I will say, the data does offer one notable silver lining here.
Oh, what's the silver lining?
It proves the global slowdown isn't completely uniform. The UK economy surprisingly grew 0.5% in February.
Oh, wow. Which beat economists' expectations, right?
It did. And Europe has been highly exposed to energy shocks over the last few years, so seeing 0.5% of growth there is a critical reminder. Modern economies are highly complex.
Yeah, they aren't just a monolith.
Right. Even amid a broad global slowdown, pockets of resilience still exist. Corporate adaptation and consumer adjustments, they can sometimes outpace the drag of high costs.
But, okay, this brings me to the massive paradox in this briefing.
The tech sector.
Yes. If the macro environment is struggling and the average consumer's wallet is getting crushed by beef prices and energy costs, how is the U.S. stock market not collapsing?
Because tech is carrying it.
Literally. Looking at the tech sector data, they aren't just surviving. They are executing this gravity-defying act. They are carrying the major market indices on their backs.
Yeah, the tech sector is basically operating in a completely different financial atmosphere right now.
Okay, let's look at Anthropic. According to our April 2026 data, this AI company just tripled its revenue in the first quarter.
Tripled in one quarter.
Yeah. They are now sitting at a $30 billion annualized run rate. And just to clarify the mechanics there for a second, an annualized run rate of $30 billion doesn't mean they have $30 billion cash sitting in a bank account from Q1.
No.
It means you take their current massive monthly revenue momentum and project it forward for a full 12 months. It's a metric of sheer velocity.
And velocity is the operative word there.
Yeah.
That kind of rapid revenue scaling, it doesn't happen just because a piece of software is, like, kind of interesting.
Right.
It happens because enterprise businesses, Fortune 500 companies, view this technology as an existential necessity. They are pouring billions into AI to fundamentally overhaul their efficiency.
Because labor costs are high and macro growth is slow.
Exactly. Corporations look for technological leverage to protect their profit margins. And Alphabet is also emerging as a major beneficiary of this enterprise spending wave.
Okay, I get that. Massive corporations have billion-dollar balance sheets to spend on Alphabet and Anthropic. But I have to challenge this when we look at consumer hardware.
Okay, lay it on me.
The briefing shows Apple is gaining massive market share in China. iPhone shipments surged 20% year over year in Q1, hitting record sales.
Yeah, it's wild.
But wait, if consumer sentiment is at 47.6 and people are stretched thin by energy and food, how are iPhone shipments jumping 20%? People can't eat smartphones.
It seems entirely contradictory, I know. But you have to look at how the modern consumer actually values their technology.
Okay.
You have to separate local, everyday economic sentiment from the utility of global tech dominance.
I'm trying to. But if my budget is tight, a premium piece of hardware feels like the very first thing I should cut.
In past decades, yeah, that would be true. But the smartphone has transitioned from a luxury good to critical infrastructure for the individual.
Infrastructure?
Yes, it's the primary portal for banking, communication, commerce, entertainment. In a constrained economy, a consumer might cancel a vacation or stop dining out or delay buying a car.
They consolidate their entire life into their phone.
Exactly. Furthermore, the mechanics of how these phones are purchased through multi-year carrier installment plans, aggressive trade-in subsidies, it obscures the upfront sticker price.
Ah. So instead of a $1,200 hit to the bank account, it's just like a $30 line item on a monthly bill.
Right. And they view that $30 as totally non-negotiable. And specifically regarding Apple's 20% surge in China, you're seeing aggressive market share capture override broader macroeconomic headwinds.
Brand prestige is just that powerful.
It is. The tech sector, whether it's enterprise spending on AI or global consumers buying premium hardware, it has largely detached from everyday economic indicators like the price of cattle.
Which means if you are analyzing your portfolio and expecting the S&P 500 to perfectly mirror the vibe at your local grocery store, you're going to be completely lost.
Completely. The major indices are pricing in future corporate efficiency, not the current inflation rate.
But the divergence is stark, and the success of a giant like Apple doesn't exist in a vacuum.
Ryo, it creates immense ripple effects across the entire global supply chain.
Right, because one company's pivot often creates an immediate structural crisis for another, which brings us to Qualcomm.
Yeah. Qualcomm is a fascinating case study today.
Our briefing shows they just delivered record Q1 earnings. Record earnings. On paper, that sounds fantastic.
Sure does.
But the market reaction is really muted because Qualcomm is facing severe near-term headwinds. The sources point to two specific issues: memory-driven inventory corrections and the upcoming Apple modem transition.
This is a perfect lesson in how markets price equity.
Hmm,
They do not reward you for the cash you collected yesterday.
right.
They value you based on the security of the cash you will collect tomorrow.
It makes me think of a local restaurant.
Okay, let's hear it.
Imagine a restaurant that just had its most profitable night ever. Record sales, lines out the door, register is full. That's Qualcomm's Q1.
Yep.
But as the owner is locking up, they get an email. Their supplier is changing how they deliver essential ingredients, and their biggest, most reliable customer just decided to learn how to cook at home and is never coming back.
Oh, yeah.
Suddenly, that record pile of cash doesn't feel like a victory. It feels like a buffer for the coming storm.
That is a great analogy. The customer deciding to cook at home is the perfect stand-in for the Apple modem transition.
Because Qualcomm supplies the modems for iPhones.
Historically, yes. But as Apple transitions to designing and manufacturing their own modems in-house, Qualcomm is staring down the loss of a massive, heavily relied upon revenue stream.
And what about the supplier issue in that restaurant scenario?
That maps to the memory-driven inventory corrections. Supply chains suffer from this thing called a bullwhip effect.
The bullwhip effect. Okay.
Yeah. When electronics manufacturers fear a shortage, they overorder memory chips. They build up massive stockpiles.
Just hoarding them.
Right. But when they realize demand is cooling, or they just have too much sitting in warehouses, the entire industry simultaneously decides to shrink their inventory.
So they just stop ordering entirely.
Exactly. That quote-unquote correction creates a sudden, drastic slowdown for suppliers. So while Qualcomm just printed record earnings, the market is looking right past that headline to the brutal reality of their future order book.
It really highlights the danger of just reading a record earnings headline. If you don't understand the mechanics underneath it, you're flying blind.
Absolutely blind.
Now, this dynamic with Qualcomm shows how punishing the hardware cycle can be when your revenue is tied to someone else's product roadmap, which really makes you realize why companies with total vertical integration companies that control their entire ecosystem are commanding so much attention.
Like SpaceX.
Exactly, which explains a massive forward-looking signal we're seeing from SpaceX today. The briefing notes SpaceX has accelerated its scheduled vesting date to as early as next week.
Yeah, that's a massive move.
But to anyone who has ever worked a normal corporate job, vesting date acceleration sounds like standard HR paperwork.
Oh, it's not.
Right. You're looking at this as a major financial signal. What is the actual mechanism at play here?
Well, in the context of a highly valued private company like SpaceX, accelerating the vesting of employee stock options is rarely just administrative housekeeping. It is financial choreography.
Okay, meaning what?
When a company does this, they're effectively clearing their cap table. They're finalizing their ownership structure. They want to reward early employees and engineers by giving them full control of their shares ahead of a major liquidity event.
And by liquidity event, we mean an initial public offering, an IPO.
Highly, highly likely. It signals they're preparing the underlying mechanics of the company to transition to the public markets.
Wow.
Yeah, you have to get the house in perfect order before inviting outside retail and institutional capital in.
So even with consumer sentiment at 47.6, the machinery of massive wealth creation, IPO preparation, and market expansion is still turning at lightning speed at the top end of the tech frontier.
It never stops.
Let's pull all the way back now and look at the whole board. How is this macro versus tech tug of war moving the rest of the sectors? because we have some very distinct winners and losers today.
We do. And the sector divergence is telling a very clear story about how capital is trying to navigate this crazy environment.
So looking at the day's biggest market movers, the top gainers are SpaceX, Qualcomm, and Apple.
No surprise there.
Right. And the most active stocks by volume are Apple, Amazon, and Nvidia. The tech titans are completely dominating the flow of capital. But let's look at the top losers. FMC Corporation and Netflix.
Yeah.
Now, FMC makes sense. They're heavily involved in agricultural sciences and chemicals, which ties directly back to that volatility we talked about with the cattle futures.
Right, the supply chain issues.
But Netflix, in a world where tech is winning, why is a streaming giant taking a hit?
Well, if we connect Netflix back to the mechanics of the consumer wallet we discussed earlier, it makes perfect sense.
How so?
We established that an iPhone is viewed as essential infrastructure, right? Financed silently through a phone bill. A premium streaming subscription, however, is a recurring, highly visible monthly pain point.
Oh, it's purely discretionary.
Exactly. It's exactly the kind of discretionary spending that gets scrutinized when you are paying 25% more for beef. When sentiment hits 47.6, cutting a $15 or $20 monthly streaming service offers immediate, tangible relief to a household budget, and it doesn't fundamentally alter a person's ability to participate in modern society.
That makes total sense.
And capital markets understand this psychological hierarchy of consumer needs. They price the stocks accordingly.
That's a really great distinction between infrastructure tech and discretionary tech. Now let's contrast two specific sectors that are moving in fascinating ways today: automotive and energy.
Okay.
The automotive sector is actually booming. The briefing calls out Tesla, Rivian, and Volkswagen making notable gains.
Which initially seems completely counterintuitive.
Right. If interest rates are being held high by the Fed, auto loans are expensive.
Yeah.
And if consumer sentiment is terrible, people shouldn't be buying expensive electric vehicles. So what is the market seeing that the everyday consumer isn't?
The market is looking way past this quarter's auto loan originations. Investors pushing capital into Tesla, Rivian, and VW are betting on a long-term structural transition of global energy and transportation infrastructure.
Oh, because of the geopolitics.
Exactly. They're looking at the exact same geopolitical data we are, the Iran war driving severe energy price spikes, and concluding that the transition away from volatile fossil fuels is going to accelerate, regardless of current interest rates.
Which perfectly explains what is happening in the energy sector today. We talked about how the Iran war is causing oil prices to surge. Logically, high oil prices should mean energy giants like ExxonMobil and Chevron are just printing money.
I think so.
You'd think their stocks should be soaring. But the briefing specifically notes the energy sector is facing extreme volatility today. Why are these stocks volatile instead of just reliably profitable right now?
Because markets hate uncertainty far more than they love high prices. A spike in crude oil prices absolutely benefits ExxonMobil's bottom line today. But an ongoing, unpredictable war in the Middle East introduces the risk of catastrophic supply chain disruptions.
Or sudden geopolitical intervention.
Right, where governments stepping in with windfall taxes.
It's the total inability to forecast.
Precisely the issue. If you are an institutional investor trying to price Chevron stock, you don't know if oil will be at $90 a barrel tomorrow or spike to $150, or if a sudden diplomatic resolution will crash it back down to $60.
You just can't know.
You cannot model that cash flow with any confidence. And that unpredictability forces investors to build massive risk premiums into the stock price in real time, which creates intense volatility, even when current daily revenues are sky high.
So high prices equal high daily profits, but high uncertainty guarantees a bumpy ride for the stock itself.
Exactly.
So to bring this all together for you listening right now, trying to make sense of all the noise, the core takeaway is that you are living in a true tale of two markets. The headlines you read about everyday inflation, the pain at the grocery store, the anxiety over the Iran war that is all mathematically and practically true, it's happening, and it's reflected in that brutal sentiment score.
Yeah.
But the explosive corporate growth in AI, the record sales of premium tech, the forward march of companies like SpaceX, and the massive capital bets on the EV transition.
Well, that is also entirely true.
Yeah, and the mistake is trying to force both of those realities into a single unified narrative.
You just can't.
You can't. They are parallel tracks. The economy of capital and the economy of the citizen are operating under completely different physical laws right now. And as we watch this divergence, it raises a really critical question for the future.
Okay, let's hear it.
If enterprise AI and high-end tech are continually pulling the major stock market indices to new record heights, while everyday consumer sentiment hits rock bottom, what happens when they completely detach?
If the S&P 500 no longer reflects the economic health, the purchasing power, or the reality of the citizens who live within that economy, what does it actually measure anymore?
That is a profound structural question. A split-screen reality that just keeps getting wider and wider until the two sides can't even see each other.
Yeah,
It really forces you to rethink what the phrase "the economy is doing well" actually means. Definitely something to think about the next time you're reviewing your portfolio or paying for your groceries.
for sure.
Well, thank you for joining us for today's deep dive. We love taking these sources, unpacking the mechanics behind the data, and helping you cut through the noise. That's all for today's episode of Tech Money Madness. Don't forget to like, subscribe, and we'll see you tomorrow for more market coverage. Keep questioning the headlines.